Welcome to all of you, by the way. It's great to see your bright, shiny faces this morning. It is my honor to introduce my friend and colleague, Dr. Helen Currie, to kick off our program this morning. Helen is the chief economist at ConocoPhillips. This is no small job, obviously. Chief economist for a large company, large corporation, global corporation, comes with a tremendous amount. There's a lot of gravitas to that job, and so she, kind of brings the brain power to do that. Gotten to know Helen a bit, enjoyed our conversations together. Thrilled to have, of course, ConocoPhillips as one of our great independent oil and gas company members. Helen is a Mississippi native, got her undergraduate degree in economics from Millsaps College in Jackson, Mississippi. Somehow ended up in Washington State and got her master's degree in economics from the University of Washington, and did some work up there as well, I do believe, and got a PhD in finance from Mississippi State University. She has been with ConocoPhillips since 2001, became chief economist in 2017, she thinks, somewhere around in there. And this was sort of related to ultimately to the split, I do believe. Their perspective and somebody like Helen's perspective on what the world looks like in terms of energy economics from the standpoint of a company like ConocoPhillips, I think is very important, very instructive, very informational, and eminently useful. So we're honored to have you here this morning. We appreciate you coming to do this for us. So please welcome Dr. Helen Currie.
Good morning, everyone. It's great to be here. I appreciate that kind introduction. Yes, I grew up in Mississippi and a Southerner by nature. I found the summers in Seattle a bit too cold. It's a beautiful place to live. Missed the warmth of the South and came back south many years ago. So I really enjoyed Mike's comments over breakfast, and hopefully everyone here heard those. It's a bit humbling, I'll admit, because you now know that you're better off listening to a chimpanzee than listening to me as to what the future's going to look like. But hopefully this will at least be a little bit entertaining. What I want to do is just share with you some of our thoughts and some of the way we see the world at ConocoPhillips. And so this is going to be really a very, very macro kind of slide deck that I'm going to go through with you, and that's what our lawyers want you to read. So quick couple of comments about ConocoPhillips. Today we're the world's largest independent E&P. In addition to operating here in the great state of Texas, we operate across the U.S. lower 48, Alaska, elsewhere in North America, and around the world. Today we're a little over 10,000 employees strong worldwide, and we're producing a bit over 1.5 million barrels a day of oil equivalent on an annual basis. So again, what I want to focus this morning's comments on is kind of what we call the energy trilemma, and it's really thinking about how do we as an industry meet this triple challenge of delivering supplies sustainably while as demand is growing, and actually being part of enabling energy transition. And I agree with everything Mike was saying over breakfast of, sure, energy transition in some form and fashion has been with us for forever, arguably, and we continue to evolve. So what our task is as E&P companies is to figure out where do we best fit within that energy transition. And then the last thing, of course, we have to do, or some would say the first thing we have to do, is make sure that our investors are satisfied, because without that capital, we can't do what we need to do. So I first want to start with kind of it may feel a little bit like a whirlwind tour, but looking at where the markets are today and where we've been. Anyone in this room is no stranger to volatility, price volatility, market cycles. Oil, natural gas, all commodities for that matter, are famous for being very cyclical. And what we've endured through in this industry, particularly in the past 5 to 7 years, we've had two major downturns. The first one I'm thinking of is when we think back to started in mid-2014, but it was the depths of it were in 15 and 16, that industry downturn. That was a major hit to our sector, as you in this room will know. And then what we went through last year and are still coming out of is this COVID-induced downturn that's been a real blow to us, and it's changing the nature of our business, particularly from the outside, and I'll say more about that in the coming slides. So when we kind of think about oil demand and where's the global oil market, as you can see here on the left-hand side, last year was a huge dip, and these are annualized figures on a monthly basis. It was much uglier looking at last April and May. But on an annualized basis, we had a huge dip last year, and we're a large way out of it today, but not entirely. Our view is that as the global economy continues to reopen in the coming months and over the course of the next few years, that oil demand will also recover and grow along with that. We're expecting for the oil market to recover to about 100 million barrels a day on an annual basis next year. Could be 2023, but could very well be next year. And that would put us back in line with 2019's annual average. Is why that 100 million barrel a day mark is so important. But in addition to just the economic reopening shaping oil demand, there's a lot of things that have also changed kind of with the nature of the economy that will spill over into oil demand itself. So when you think about a lot of your own personal habits that changed when you had to work from home, and some of you may still be working from home, there are a lot of things that have just adjusted themselves to working from home and less travel as a consequence of COVID. And that then has spillover effects into oil demand itself. So a lot of nuances here from things that can be positive for oil demand to things that could be kind of a drag on oil demand or will take longer to recover from. But the main theme I want to leave you with is, as I stated earlier, we are expecting oil demand to grow in the future and continue to recover. Now, an important element of growth as we see it is that oil demand will probably be growing at a slower rate than it was in the past. And that slowdown in the rate of growth is more attributable to energy efficiencies, vehicle efficiencies, as well as the penetration of electrification and other alternative fuels in the transportation sector. So those things will kind of be a drag on the rate of growth of oil demand, but we are expecting the market to keep growing in the future. Turning a little bit to supply, we look at the global supply picture and think about what's different from pre-COVID. So what the message I want to leave with you here is in today's post-COVID new normal for U.S. production, we're on a growth trajectory. We think we will be on a growth trajectory, particularly getting into 2022. But it's important to note that it's a lower growth trajectory than we were anticipating pre-COVID. It is still led by a lot of production growth out of Texas, tight oil in particular, coming from Permian, but Eagle Ford as well. But the U.S. oil production outlook is clearly, as shown on the graph here, consensus experts are seeing it at a lower level than it was previously. Now, that has nothing to do with resource in the ground. It has everything to do with what we call above-ground risks or factors. The key things that are shaping that are capital discipline and ESG and cost of capital factors. So looking at cost capital for just a moment, as you know, lower 48 tight oil as well as shale gas arguably became more sensitive to the capital markets or more exposed to the capital markets over the last decade as a consequence of more publicly traded companies moving into that unconventional production space. And as the sector underwent two major downturns in the last 6 years, we saw the non-investment grade energy producers pay an especially high premium to obtain capital relative to other non-investment grade producers as well as other sectors. We know that our sector as a whole has tended to see a relative increase in cost of capital relative to non-energy, particularly non-fossil fuel sectors. And along with that, we've seen a lot of consolidation in the industry. Some of that consolidation was the consequence of financial distress, so quite a few bankruptcies that have been filed. Texas is a big concentration of that financial distress. No surprise, because we simply have a large number of producers based here in the state. But with that, people come out of bankruptcy, and again, they, as you know, they carry on production, or they may consolidate with another company. But between the U.S. and Canada, that's where the largest number of trades have been taking place. And we think there'll still be some more consolidation as we go through the next few years within the industry. Particularly that consolidation is partly driven by this notion of capital discipline and focusing on free cash flow and returns to shareholders or other investors. So where that then leaves us, that view on U.S. oil production, where that then kind of leaves you with respect to what role does U.S. oil production play in the overall global marketplace? Because you have to keep in mind, everything we do, every one of you that are producers, you're competing in a global marketplace. Even if your business is strictly producing and delivering in Texas, our prices are globally determined. So everybody's a global business person in this room. So when we then think about, so what does that global supply picture look like? It's quite interesting, something quite daunting in some ways for a U.S. producer. So the first thing I would say is U.S. production is and should remain a significant part of the overall global supply mix. It's important to recognize that we as U.S.-based producers are trying to compete in a marketplace that's more challenging than it was in the past. And one reason it's more challenging is because of what I call the ROPEC coalition. So OPEC plus Russia, plus a handful of other countries, are acting in concert with each other, have been doing so for several years now. And today they manage about 50% of global production. So a lot of people don't realize just how much production is managed directly or indirectly by OPEC and Russia. And looking forward into the future, here in 2050, projections there on the slide. But in general, the expectation is that the Russia-OPEC coalition will only grow in its influence over global oil supplies and therefore global prices. So the thing to be tuned to here is what are the politics, what are the international policies that then influence their behavior, and it's not just a matter of, well, what are prices and what do they need to balance their country's fiscal budgets. There are a lot more subtleties that of course go into influencing their decisions on whether to ramp up production or to slow it down to influence global prices. So with that, I want to turn a bit more to looking further into the future and looking bigger picture at overall energy transition and what roles do oil and gas play in the future energy mix. So a couple of busy charts here. On the left-hand side is just an array of industry and consultant projections for oil demand out to year 2050. And then similarly on the right-hand side for natural gas. So to first kind of speak to a point that Mike made at breakfast is, there's a lot of talk about peak oil. That seems to be a constant, I guess, is oil demand's going to peak next year, and then it doesn't happen. Well, next year, and then it doesn't happen. At some point, it will peak. And quite frankly, we're not sure when. Our base case is that on a global basis, it probably peaks in the mid-2030s. Between now and the mid-2030s, what's going to happen, where you're What's going to slow down oil demand growth is going to be vehicle efficiency. What's going to prop up oil demand growth is going to be the petchem sector, plastics, things of that nature. Once you get beyond the mid-2030s, electrification, other alternative fuels, they probably start to play a bigger influence. They're not going to turn the fleet over, just in 1 or 2 years, but over time, assuming electric vehicles do continue to improve and penetrate, looking 20 years out, they could start to have a much, much more material impact on oil demand. But the good news I would point you to from this page is very simple, is that even in your worst case outcome, let's say for oil or for natural gas, they're still there in 2050. So it's not as though these very important, efficient energy sources are going away. But even in what you may be familiar with, IEA's net zero case, which is the lowest line over there on the left hand for oil, oil is still needed through 2050. So even in these 1.5 degree, 2 degree kind of climate change worlds, oil and gas are still going to be needed. And of course, in order for that oil and gas to occur, you need capital. So here are just a couple of quick numbers. I want to focus more on the right-hand side of IEA's estimate for how much capital needs to go into oil and gas in the sustainable development case. So that was their 2 degree scenario. This is from last fall's release of the IEA's World Energy Outlook. So even in their 2 degree world, looking out to 2040, you need over $12 trillion, trillion with a T, invested in the sector, and that would be with oil demand falling over time and gas demand pretty stable. Because on the left-hand side, that stacked bar chart, hopefully you can see both oil and natural gas still being in that energy mix in the 2 degree case. But those would be the volumes that correspond to, hey, we still need $12 trillion to invest to get those molecules developed and deliver them to market. So I wanted to leave this part of the conversation with some focus on net zero. So as you know, the whole conversation around climate change ambitions and targets has evolved from a 2 degree world to now we're talking about net zero, which is effectively a 1.5 degree kind of temperature change out to year 2050. And this is what's setting the tone of policymakers' viewpoints and votes, and this is really setting a tone for what we as an industry have to be part of and have to be successful in. But that being said, this is no doubt a challenge both for our industry as well as for society. And some real simple ways that I try to look at that and convey to people for why is net zero challenging? Why is net zero expensive? Because it absolutely will be. Is first of all, 30 years is actually not a long time. Some of us in the room are maybe old enough that we will say, 30 years ago seems like yesterday. But in energy space, it really is not a long time. If you look back to 1990 versus today, that's a 30-year window. What happened? The population of the world grew 2 billion people. So we're today at about 7.8 billion people. And in the same time, the global economy more than doubled, grew by 125%. And when you then look at what were the energy-related greenhouse gas emissions, which is on the black line on the chart over there, you can see that clear upward trend over that 30-year period. So what the task that we're being set up with for the next 30 years is one wherein the world's population is expected to again add another 2 billion people, which will put us close to 10 billion in 2050. And we would certainly hope the economic outlooks are reasonably accurate. The global economy doubles over this next 30-year period. And then the challenge for us is to get on those green lines in terms of greenhouse gas emissions. And it is a real challenge. And be clear, this is not to say that energy demand goes away. It's a matter of what is that demand comprised of, And then secondly, what are the emissions, the GHG emissions associated with that? And that is this challenge for us. And it's important that we embrace this challenge. I would argue it's important that we embrace this challenge because we as an industry are already part of it, whether one agrees with it or not, it is here and it is with us. So with that, I want to then move to some of the things that we at ConocoPhillips do to try to ensure that we're positioned to be successful in this energy transition, which is going to push us towards lower and lower GHG emissions. So one thing that we do in ConocoPhillips is we rely a lot on scenario planning. So we may recruit a chimpanzee after listening to this morning's breakfast speaker, since that may actually improve our capabilities. But what we do is we don't try to pretend that we know the future. My job is talking about what the future may look like, but I'm very intentional to try to convey that we're not going to get this right. What we want to do as a business is get ourselves in the right ballpark. I can't tell you what seat you're going to sit in, but I need to get you in the right ballpark for 10 years out. So the scenario modeling that we do is, excuse me, we do actually examine the world's total energy mix, and we kind of make these projections out through beyond 2050 to see how both oil demand, gas demand could evolve within a broader energy context, and then what would be the GHG emissions associated with those scenarios. Some of the information I'm referring to is actually available in the company's Sustainable Development Report, which is also on our website. But one other step we take, which we find particularly informative, is we actively monitor signposts that are indicators for this scenario or that scenario. And what that does is it enables us to have a quantifiable gauge of what direction are we moving? Is it east or west? And then what is the pace? How fast do we think we're moving? Because those are the things that we find particularly useful in helping us to formulate some business strategy and capital allocation decisions, is knowing what is the direction and how fast are we moving there. Something else we do in terms of trying to position ourselves for the future is focusing on low cost of supply. That's not actually written on the page, but low cost of supply, capital discipline, which we talk about in terms of free cash flow expansion, having a strong balance sheet, and having strong distributions to our investors. And then the fourth leg of that chair is the ESG component, where we prioritize the environmental, social, and governance aspects. As many of you know, we're one of the first companies to come, or E&Ps, to come out with what we call a Paris-aligned climate strategy. We do, in our operations, we focus a lot on GHG intensity. And then from a policy standpoint, for years, this is not new, for years we've been an advocate for a price on carbon. There's a lot of details in what a carbon price policy may look like, but we've generally been an advocate of there being a price on carbon. In the social aspect, we do a lot of work in terms of workforce diversity and inclusion. Those are important elements to our culture. And then from the governance standpoint, we have a very diverse and well-engaged board of directors that prioritizes transparency and good reporting in terms of compensation programs and so forth. So that kind of wraps up some of the elements that we find helpful at ConocoPhillips for what are the things that we think will help us be successful in positioning ourselves for and navigating for an energy transition that's going to we think is going to correspond to a lower carbon future world. So a couple of quick comments to close, to wrap up. I know I've given you a whirlwind tour of a lot of issues. But to wrap up, I just want to reiterate, it is no doubt a critical time for our industry in many ways. As discussed, we're tasked with providing energy, providing an essential element of everyone's daily life, and providing it efficiently and affordably and reliably. And at the same time, we are asked to do this, we as E&P companies are asked to do this while we're providing adequate returns to our shareholders and other investors, and then also look for that GHG reduction, look for that way to achieve net zero ambitions. As I also mentioned, the good news from this whole conversation is that oil and gas will be needed. In our opinion, oil and gas will be needed for a very long time in the future. You know those reasons why. It's affordable, it's efficient, it's reliable. The last comment I want to leave you with is related to public policies, because no doubt our policymakers often do not have energy backgrounds. And so it is incumbent upon us to work with them to try to help them better understand what it is we do, and better understand that we do actually do it quite responsibly, that we are good people, as Mike put it at breakfast, and that we do have nothing but good intentions in running our businesses, and in businesses that happen to provide a vital part of everyone's daily life in the form of energy. So helping those policymakers understand this is what we're trying to do is important, because otherwise policymakers, as we've seen in the past, may pass one policy that they think is going to do one thing, but it actually has very different consequences. And I think today, I'm bringing this up because I think today we're particularly at a point of vulnerability whereby there are policies being discussed that could actually have some very adverse consequences depending on how they played out. And again, it's incumbent upon us to try to help policymakers understand it, as well as the public, because they're voting for those policymakers. So that concludes my remarks. Thank you very much. It's been an honor to be here. So I appreciate your time. Car's going to come up here.
Well, don't run off yet. First of all, are there any questions any of you have for Dr. Currie? I'm sure she's happy to entertain those questions. Yes, sir.
Dr. Currie, do you see any policy constraints on that growth of GrowTech as it relates to their emissions? If we're seeking cleaner fuels, cleaner energy sources, do you see either global or U.S. constraints on that growth pattern that you project?
Yeah, and that's a very relevant issue. So with respect to whether or not there are or could potentially be policy constraints on the emissions of the Russia and OPEC coalition's production, needless to say, today there are few, if any, based on the countries themselves and their operational practice. But that's a perfect case in point of where there would need to be some type of global coordination. The one way that some of this is kind of manifesting itself today would be when you think about Europe's border carbon adjustment. That is one way that a country or group of countries could effectively impose a cost or a fee on the GHG intensity or some other aspect of those producers' output and bring it into those markets. But otherwise, aside from something like that, no, that's one of the issues that leaves places like Texas and U.S. producers kind of exposed to an uneven playing field. And that's what we're trying to resolve, is just make sure that playing field is more even.
Anybody else? Well, so I've got a couple. So your last point, this notion of unintended consequences, people who do what we do spend a lot of time thinking about and talking about these things. And then the question inevitably is, well, for example, well, if we knew that, then it wouldn't be an unseen or unintended consequences, something that develops in the future that's unforeseen in terms of its negative consequences. The great economist, Dr. Thomas Sowell, says there are no solutions, only trade-offs. And so it seems like this discussion about energy transition and forced energy transition in particular is fraught with peril in that regard, because I think a source of frustration, certainly to me and probably to a goodly number of people in this room, is this discussion seems to be devoid of that second aspect of that. What are these trade-offs potentially? Do we sort of create another crisis in the economy, either domestically or globally, by applying this solution here? So it's sort of a vague question, but what are your thoughts on this, and how do you go about communicating these pitfalls to policymakers when you're given the opportunity?
Yeah, Carr, that's a very, very relevant issue that we do contend with, because those of us who are familiar with economics do look at the world through the lens of there are trade-offs. It's the classic "there is no free lunch" phrase, and that's one of the points that is hardest to get across to policymakers, is that simple point, or seemingly simple point of, if you do this, there is a trade-off somewhere. You may not see what it is today, sometimes the problem is just simply they don't disagree with it, so you pretend it's not there if you don't disagree with it, which is not a fruitful outcome. But that is the essence of what some of what we try to communicate, is that if certain policies are constructed in a way that either push consumers or push the industry in one direction, there are going to be some other consequences elsewhere that we try to make them aware of. Maybe a different way to approach the question is, when we think about policies that are making it more challenging to be a producer in the United States, it has impacts on domestic jobs, because you're pushing that activity overseas. One of the things that we're currently engaged in is trying to help policymakers understand that just because you do something to reduce U.S. production, that doesn't affect global demand. Global demand is still there. All that does is shift where the production comes from, and therefore shifts where the jobs the job activity is taking place. But yeah, it's a message that may seem obvious to us, but for many policymakers, it's just trying to get them to understand that you're not going to reduce global oil demand by simply rearranging where the production is occurring, and it's trying to help them understand that.
Well, so I was having a thought this morning. Mike was talking about the laws of thermodynamics and the fact that these can't be done away with. I suppose I'm of the mind that the foundational laws and principles of economics are the same way. The law of demand is what it is. The law of supply is what it is. So you can try to tweak these things with policy changes. So there's sort of this notion about an energy transition. And to me, as a free market economist guy, we've had this conversation. The starting point is always that, an economy that is utterly unmanaged by anybody. And then you see what a transition brings. I sort of thought when crude oil prices were going sky high in 2008-ish, this is sort of where we were headed. The sense of the peak discussion was about peak supply then, not about peak demand. And this notion that we were on the downhill side of that, well, we've turned that notion on its head quite plainly. And so a transition occurs when markets begin to sense that things are occurring, and then it begins to do things with price signals and whatnot that bring about this transition. So you've got that on this far side of the continuum. On this far side of the continuum, you've got management of the economy in virtually every respect. So how far this way are we willing to go? Welcome to react to that. I'm curious about carbon pricing in that sense. So that's clearly an attempt to do something in terms of managing an outcome and economic implications that come along with this. So have you given notion to the logistics, the mechanics by which a price on carbon would be accomplished?
So one reason that we have tended to advocate for a price on carbon, and at one time this was over a decade ago, ConocoPhillips was a backer of the U.S. CAP, which was a cap and trade organization. Today, the cap and trade argument for U.S. policy simply has not gained traction. Over the last decade, the conversation for U.S.-focused policies has had somewhat more traction on this from the standpoint of a tax. Some reasons that a tax could be better for a business is to some extent the certainty, the relative certainty of what that tax would be, how many dollars per ton it would be this year, next year, and so forth, versus the cap and trade, which would probably have a more volatile price. So that's a little bit of background of why where our position has been with respect to pricing. I want to be clear, that being said, we also recognize that because climate change or the global temperature is, by definition, it is a global issue. It is important for governments around the world, if any one area is going to impose a price on carbon, there has to be some transmission of that price to other economies, because inevitably we trade with each other. So where this takes us is you either have governments that intentionally impose a carbon price in their economy, and then they sort out the border adjustments, or you move towards a world where more federal governments, I should say, are somewhat acting in concert with each other to price carbon in an outright manner across their economies. It's going to get priced one way or another. It's a matter of how. So what we're trying to get at is actually what would be a more transparent and durable type of pricing framework. Because if we don't push that platform, we're going to end up with a hodgepodge of different policies, where we are today, and you end up with a lot of what I would argue are more complicated mechanisms that are far less transparent. And case in point is trying to sort out how the EU today is going to structure this border carbon adjustment, right, and what it's going to do to LNG coming in or gasoline and diesel coming in. Well,
I could continue this for a couple of hours as we've done in the past, so I won't subject all the rest of you to that. We'll do that some other time. Anything else by anyone? Yes, sir.
Yeah. Would you say that ESG, the adoption of ESG should be throughout the E&P value chain? By that I mean high, medium, and low E&P companies. It's just not for the large ESG requirements. The regulators seem to say it's not a production requirement, it's an ecosystem requirement. And all companies throughout the value chain need to adopt the ESG going forward. Is that the way you? That is,
and I would actually kind of turn it around and look at it from a different standpoint, which is that the financial sector is going to impose that on everyone regardless of size. So insofar as access to funding, or it could even be your cost of insurance, starts to get toggled up or down based on your ESG rating. Those are things that affect every company regardless of size. So yeah, it's an issue that I've tended to look at it as look out your rearview mirror for what's coming there, because it's coming from the financial sector, whether it's your local state bank, or a global investment bank, or even your insurer, because they all have to comply with excuse me, various forms of capital adequacy and financial market requirements, and our greening of the financial system out of Europe, and our U.S. Federal Reserve signed up with NGFS last December. Our current SEC chair is on board with that whole set of issues. You have a U.S. Federal Reserve Board of Governors that many of whom, if you read their writings, listen to their speeches, they too are aligned with greening of the financial system. So that's why I say it's going to come one way or another, and it'll affect companies regardless of size, I think.